Good evening, everybody. Before I introduce everybody, I'll introduce myself and my colleague. I would like to thank all of you for coming out here. It's been a heck of an experience with. Sorry about that. A heck of an experience with the support of all the classmates and all the people that have been with us in the SMIF lab. So I would like to thank all of you for that. My name is Kendrick Bernal. I'm the sector manager for industrials, and this is Karina Mursuli, and she is an analyst in our sector. And we would like to start off giving a brief intro of the industrial sector. Now, the industrial sector, despite the importance that it's had historically with the growth of the developed world, it's a sector that is admittedly not a very sexy sector at the moment. As you could see in the graph, the industrial returns noted by the shaded area has not been at the same level as that of the generalized S&P return over the past year. But to see that and to think that industrials is not a worthwhile sector to invest in would be a criminal mistake to make because of the importance that it has towards the general economy. Now, being a sector that is so intrinsically ingrained with the health of the economy, the two main drivers that help spur the growth of the industrial sector as a whole are the gross domestic product and purchasing managers index, and this is because they gauge the health of the general economy at large, and they are a way of assessing the level of capital expenditures that are being made by the firms in the economy. Going more into, in particular, in the transportation and infrastructure sector, you see that we have a number of drivers that should help the sector achieve a good level of growth in the upcoming years. You can see there is a combination both of the high supply of certain commodities like the oil, natural gas, with the high production levels of those same things. And you also see forecasted growth in general aviation activity and a growth in chemicals production to increase over the next few years. So these are a few charts showing how the trends you have seen a growth in the crude oil production, as well as a significant drop in the price of crude oil, which, even though it has picked up a bit in the last few in recent days, it has not been enough to recover to its former prices. A similar case you see with natural gas production and natural gas prices. As the production has increased over the past 10-15 years, you see the level of the gas prices decreasing. So, to introduce our company, I will now pass it on to Karina.
Hi, everybody. Thank you for taking your time to come and listen to us. And we would like to introduce Macquarie Infrastructure. Looking for companies in industrials is not a fun thing. We're looking for a company that would suit our portfolio and actually help us diversify all the risk involved with the industrials. Oh, I apologize for that. Okay. So talking about the Macquarie Infrastructure, we have different four sectors that we derive revenue from. The major sector is aviation. That's why we list it as an industrial. And our company owns Atlantic Aviations, which provides different services as FBO, fixed base operations, to fuel and service the planes that land and take off in the territory of the United States. On the other hand, we also have IMTT, which stands for International Maintenance Tanks, which is consists of about 90% of our revenue sources. Another sector is Hawaii Gas, as well as contracted power and energy. I'm going to go into details of what our company does and how does it derive its revenues. So when we're looking at contract power and energy, the company believes in renewable energy. Although the oil prices have been down, and yes, we've seen that not many companies are interested in renewable energies, there are some indications that some states, such as Hawaii, they are interested in renewable and cheaper energy, such as natural gas. Solar energy, wind power, and natural gas are the main areas where the company wants to invest their capital. Although the major thing that happened recently in February of 2015, the company has acquired the Aviation Sector in New Jersey, which powers the city of New York, the Zone J. As we know, the city of New York demands a lot of power. They need in order to function. So, and also is right after Long Island is the highest prices for electricity utility. The company wants to expand the generation power up to 700 megawatts. The Atlantic Aviation has different about 69 locations. As I mentioned before, the company derives their revenue as a fee base for the businesses and private jets, takeoffs and takeoffs and landing. They actually service the planes. They provide different equipment such as Wi-Fi on board, and they provide fuel, de-icing, and they charge a fee for that. The international matrix tanks. In July of 2014, the company acquired the last 50% of the international OMTT, and the aggregate capacity for it is 45.2 million barrels right now, and it's one of the largest independent bulk liquid terminal, as known in United States, although they do have two in Canada. And because the revenue that IMTT derives is diversified, we're looking at we mitigate the risk of losing major customers. For example, chemicals, vegetable oil, and petroleum. If any of this fail to generate profits, the other one can pick up, and the company usually derives their revenues from contracts, which are typically 4 to 5 years in length. The Hawaii gas is one of the only, actually, pipeline that provides utility to non-residential and residential users in the state of Hawaii. And because of the new initiative that has been launched in 2008, where the state is looking for the cleaner energy, they're trying to, rather than drive all of their using the oil as a energy, they're looking for something that is cleaner and it's reusable as well. And I'm gonna hand it back.
Now, what excites us about this company, as we have already mentioned earlier on in the presentation, they have undertaken a number of acquisitions within the past year, and these acquisitions have all helped improve the potential, the growth potential for the company across its different areas. And we also see a number of trends that could help the company's growth in the future. Namely, we have seen an increase in storage demand because of the oil supply shock that has driven down the price of oil. We have seen that, at least temporarily, there has been an increase in the demand because companies are preferring to store the oil and kind of like write out the time to see if the oil prices pick up. So that in 2014 we saw an increase in the utilization rate of the tank terminal business. Also, there is an increasing trend of electricity generation from sources other than the traditional fossil fuels, namely natural gas and other renewable sources, which are the sectors in which the company has been investing in recent years. And we also expect to see an increase in general aviation activity over the next 20 years, and this activity is mainly spurred by business travelers. So a few of the risk factors, the main risk factors that there would be with this type of company are changes in interest rate, changes in commodity rates, and a general decline in economy along with tightening government regulations. But how do you mitigate those risks? Well, you can hedge against these risks by using derivatives. You can expand. This company has also been expanding through a combination of cash, debt, and equity, and as a result, they haven't been solely relying on acquiring debt to be able to finance their acquisitions. And also, very key point about this company is the fact that they have a very unique diversification. It's important to know that not all companies, very few companies, if any, are involved in the sectors that this company is involved in. So as a result, you won't necessarily see a general downtrend if any of the companies does get affected. So now we're going to go in more into the financial analysis valuation part. So with the ratio analysis, the key points is that you will see an increase in margins over the past few years, and this growth has been achieved through a mixture of organic and through acquisitions. Now, with relative valuation, we see that the price to sales and price to book is higher than the industry. However, this is mitigated by the fact that we have seen a higher compounded annual growth rate, 5-year compounded annual growth rate than the industry, and we also have a lower debt to equity ratio than our industry. So this would also indicate that our company shouldn't have any problems covering its debt obligation. Now, when we were performing our valuation analysis using the DCF assumptions, WACC of between 6 to 7%, growth rate 3 to 3.5%, tax rate of 32.32%, we arrived at a target price of 98.48 compared to its current price of 83.31 cents. Now, we achieved this may look like a relatively modest valuation, but when compared to some of the analyst reports that we saw that were giving it a value of much above this level, we felt that it would require a level of growth that would just be unsustainable. So to sum it all up, with Macquarie Infrastructure, you gain a company that is diversified across industries, with important acquisitions in its portfolio over the recent history, with potential to grow more. And it should benefit from the expected general aviation growth and increase in the oil and chemicals production. So to top it all off, I would recommend a buy for Macquarie Infrastructure. We'd like to open the floor for questions, and thank you very much for hearing our presentation. Yes.
How does this tie into Macquarie, which is an Australian infrastructure group? Is this one of several companies?
Yes.
How are they distinguished from their other ventures in the U.S.?
Well, Macquarie Infrastructure is a subsidiary of the bigger Macquarie Group, and the Macquarie Group is a group that is very diversified across different fields. So their other businesses that are involved in infrastructure are more so in the asset management side of the infrastructure rather than in the direct operation of those facilities. And as you know, they also have a number of other subsidiaries, mainly in the financial sector as well. So that's how they would be differentiated from other infrastructure operations that you may find.
And I would also like to add that Macquarie uses as a management. They're using the Macquarie management. It's outside. It's Australian, with the Australian headquarters. So they actually do not employ necessarily like their own. They leave that to outside managers to where they can oversee the operations better, look at the numbers, see whether the overhead is high or where we need to cut our costs, and or where we need to invest to diversify the portfolio of the company, as well as drive the dividend growth and ability to sustain their physical plants, because this is an infrastructure company, which requires about 80% of their funds to go back into the business and maintain their physical plants.
Yes. With the PE multiple, what you see.
Right. Okay. So
yeah, it's currently 5.
So, what do the earnings prospects look like going forward?
Well, the earnings prospects, we are expecting potentially around the 30% increase in revenue, because we are taking into account the potential that the new acquisition of Bayon Energy Center earlier on in this year. This would dramatically increase the power generating capacity that the contracted power and energy sector would have, and as such, we see that would be our main driver going forward.
After that?
This is what the main drivers. Within 6 months, they were able to increase their revenue about 250 million just from.
I asked that because at 5, you would assume that it's discounting much lower earnings.
And that's.
Or your target price would be higher. Your target price, I mean, if you just.
It is higher.
You got 20% built in every year. You're 5 times earnings. So.
So, with respect to the price to earnings, there was a situation that in 2014, as a result of the large activity in acquisitions, there was a significant amount of goodwill impairment that was applied to the net sales, so that also affected the price to earnings ratio.
Can you put a slide before that?
Yes. So as a result of that goodwill impairment, that's why you would see that sharp increase in many of the return metrics.
So I want to kind of talk about your valuation and specifically the valuation methodology. So this is a company that's in 4 pretty disparate industries. Why wouldn't you use the sum of the parts and compare each of the valuations versus peers like Hawaiian Gas versus other gas distributors? And then when you take a blended valuation approach of 4 different disparate industries, aviation, gas, utility, and so on, what is your industry? Who are you comparing this to? What are the companies that are distributing gas and operate aviation BPOs?
Well, we decided to compare it to. Right now, we decided to compare it mainly to other companies that are providing the air services, because the majority of our revenue stems from that source. As a result, we thought that it would be a more fair comparison to compare ourselves to other companies that specialize more in that sector, because it just wouldn't make much sense if our other sectors of revenue generation are a lot smaller to be comparing them against, let's say, for example, Kinder Morgan for the oil storage type of business. So that's why we decided on using that methodology when doing the relative valuations.
Who were some of the comps?
Some of the comps we had against. I'm trying to remember the name. No, I'm trying to remember the name of it. Okay, one of our important comparisons, one of our important competitors is Jet Aviation, which is owned by General Dynamics. That was the three principal operators in that sector are Jet Aviation and Landmark Aviation, which is a privately held company.
How are you comparing valuing this versus General Dynamics, which is a defense contractor, and then the other company you said is private? So how do you compare valuation there?
Well, when comparing to the industry, there was a number of other air service providers, airport service providers that we compared it to. So we were able to get the averages for that industry and use that to compare it to Macquarie's ratios. Yes.
So the goodwill impairment that they had, how much was that for, and where did it come from? Which unit?
The goodwill impairment was for about $1 billion. About $1 billion because that goodwill impairment came from the acquisition of the Idaho Wind Partners in 2014 and the acquisition of the remainder of the International Matex terminal business, which was previously jointly owned with another company. So what they did is that they acquired that percentage, and now it's a fully owned subsidiary of Macquarie Infrastructure.
All right, so let's go ahead and take a vote so we can proceed here. So how many in favor of this company? We have one. Okay, great. Thank you. All right.